The landscape of global capital markets fundamentally fractured on June 12, 2026. For 24 years, the internal financial mechanics of Space Exploration Technologies Corporation were locked heavily behind closed doors in the private sector. The transition to the public market wasn't merely a listing, it was an unprecedented structural event. Today, we're analyzing the anatomy of the largest stock market debut in financial history, the SpaceX epic, and the realities behind the SPCX IPO.
Welcome to Balance of Economy. Before we break down the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or recommendation to buy or sell any asset. Let's look at the numbers.
To properly map this corporate monument, we have to systematically dissect its architecture. Today's briefing covers 5 key structural pillars: the SPCX debut, engineering the slim float, capital deployment and orbital AI, valuation friction, and the tiered lockup architecture.
Section 1. The SPX public debut.
Let's start with the June 12 market earthquake. Retail enthusiasm often obscures the narrative surrounding an IPO, but we're focusing strictly on the raw structural data. Under the ticker SPCX on the Nasdaq, the baseline metrics were firmly established. The offering priced at $135 per share, valuing Elon Musk's aerospace empire at a staggering $1.77 trillion, and that was before a single second of public trading had even commenced.
The aggressive price action on day one proved the sheer scale of institutional and retail appetite. The stock surged 19%, closing the session at $161. At its absolute peak, this briefly pushed the market capitalization past $2.1 trillion, instantly elevating SpaceX to the 6th most valuable listed company in the United States. To the retail crowd, this was a massive coronation of commercial space exploration. To quantitative analysts, however, it was a masterclass in financial engineering and strict supply management.
Section 2. Engineering the slim float. That brings us directly to the structural mechanics of the capital raise. The success of this debut wasn't left to market sentiment. It was mathematically insulated. SpaceX floated exactly 555.5 million Class A common shares. This massive block raised up to $86 billion with the over-allotment option. But here's the critical data point. That represents a mere 4.2% of the company's total capital. By selling only this tiny fraction, SpaceX engineered an artificial supply squeeze against immense global demand. This mechanical restriction effectively anchored the public price for the remaining 95.8% of private equity still locked outside the market. It created a violent, undeniable asymmetry. This capital structure was so disruptive it forced exchanges to actually rewrite their rules. In May 2026, the Nasdaq specifically modified its methodology to allow megacap IPOs to join the Nasdaq 100 index after just 15 days of trading. But there is a severe limitation here for passive index trackers. Inclusion and weighting within major indices are calculated based on float-adjusted market capitalization. Because the real float is only 4.2%, SpaceX's actual weight in passive indices is a microscopic fraction of its multi-trillion-dollar valuation. This effectively neuters the mandatory buying requirements of passive trackers, concentrating the trading volume entirely among active market participants. Section 3. Capital Deployment and Orbital AI. Why does a company that successfully managed its own liquidity on private markets for over 2 decades suddenly require $86 billion in cash? Moving past the standard corporate narratives reveals the true destinations of this capital influx. First, there's the brutal reality of the Starlink rollout. It's the only commercially profitable segment right now, but the low Earth orbit constellation demands a permanent capital flow to fund mandatory hardware replacement cycles every 5 years. Second, there are the heavy industrial logistics required to validate the Starship program's full commercial reusability, which is absolutely vital for securing long-term NASA lunar contracts. But the third pillar is the real wildcard justifying this monumental valuation. In February 2026, SpaceX acquired xAI on a structural parity basis, valuing xAI at $125 billion against SpaceX at $1 trillion. A massive portion of these IPO funds isn't going to rockets at all. It's allocated to building immense data centers, specifically sovereign space-based computing nodes directly in orbit to power xAI's heavy data processing models. Make no mistake, public investors are fundamentally financing an orbital computing infrastructure designed to dominate the next decade.
Section 4. The private shareholder friction.
Transitioning a 24-year private legacy into the public markets at this magnitude does not happen without significant institutional friction. For 2 decades, SpaceX fed exclusively on venture capital. The new public pricing triggered deep concerns among early-stage private backers. Ross Gerber, an existing private shareholder, labeled the $1.77 trillion opening valuation alarmingly high. His skepticism is grounded in the raw data. The company was valued at just $400 billion merely 13 months prior. To traditionalists, this sudden multiplier reflects retail faith in Elon Musk rather than grounded financial fundamentals. Objectively contrasting the data highlights this friction perfectly. The conventional financial reality of 2025 showed $18.7 billion in revenue against a trailing net loss of $4.94 billion. Yet institutional IPO proponents justify the massive premium by pointing to an orbital communications and AI infrastructure monopoly. The XAI contracts signed with tech giants validate the market positioning, while Starlink offers rock-solid, recurring commercial revenue that the private venture market simply could no longer sustain alone. Ultimately, this IPO provided unmatched liquidity and a highly necessary exit door for historic employees and early backers.
Section 5. Tiered Lockup Architecture.
To manage that exit door and prevent the market from completely collapsing under an avalanche of newly unlocked private shares, a highly defensive mechanism was required. Lead underwriters Goldman Sachs and Morgan Stanley engineered an unprecedented tiered lockup structure. Instead of the traditional 180-day cliff where all insider shares hit the market at once, they implemented a progressive, wave-based schedule. The triggers are highly conditional. Up to 20% of eligible insider shares unlock at the first public earnings report. An additional 10% opens only if the stock price holds at least 30% above the IPO price. Various minor tranches then unlock in carefully managed waves between days 70 and 135. This architecture is specifically engineered to prevent massive insider dumping and naturalize secondary liquidity over time.
The tightest constraint within this entire architecture falls directly on the chief executive. Elon Musk retains ultimate dominance through 42% total equity and 82.4% of the voting power, utilizing exclusive supervoting Class B shares. However, he is bound by a strict 365-day freeze. This one-year ban guarantees to the public markets that the captain of the ship cannot liquidate his positions while the supply dynamics of the public float adjust to reality.
By merging heavy aerospace hardware infrastructure and artificial intelligence under a single public entity, Wall Street has been forced to adopt the aggressive valuation metrics of private venture capital. In a market this split, you are either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed.